Ever wondered if your current trading strategies are as effective as they could be? Perhaps it's time to delve into the world of candlestick patterns, specifically the Hammer Candlestick pattern. This intriguing pattern has the potential to drastically enhance your trading strategy, and today we're going to break it all down step by step. First, we need to understand what exactly a Hammer Candlestick pattern is. Picture this: a hammer. It's got a long handle and a small head, right? The Hammer Candlestick pattern mirrors this visual. It's a pattern that appears in price charts of financial assets, and it's characterized by a short body with a long lower wick. The body represents the range between the opening and closing prices, while the wick, or the shadow, shows the high and low prices of that period. So, how does one spot a Hammer Candlestick pattern? The pattern emerges at the end of a downtrend, a bearish signal, and it indicates that the market is attempting a bullish reversal. The longer the lower wick and the smaller the body, the more significant the potential reversal. Now, on to the trading process. The first step is to identify a Hammer Candlestick pattern in a downtrend. This means you are looking for a short body at the top with a long lower wick and little to no upper wick. The color of the body isn't that significant. It can be either filled or hollow. Once you've found this pattern, the next step is to wait for confirmation. This comes in the form of a bullish candlestick that closes above the high of the hammer candle. This is a crucial step, so patience is key. Jumping the gun could lead to false signals and potential losses. The third step is to set your trade. Buy a call option with a strike price near the current market price and an expiry that gives the trade time to work. Then, set the stop loss slightly below the low of the hammer candlestick. This limits your potential loss if the trade doesn't go as planned. The final step is to set your profit target. This should be at least twice the risk. So, if your risk is the distance from the entry price to the stop loss, your profit target should be twice that distance. To summarize, trading with the Hammer Candlestick pattern involves 4 key steps: identifying the pattern, waiting for confirmation, setting the trade, and finally, setting the profit target. Remember, the Hammer Candlestick pattern is a bullish reversal pattern that appears at the end of a downtrend, and it's identified by a short body with a long lower wick. However, like all trading strategies, it's not foolproof. Always ensure you're managing your risk effectively and never risk more than you can afford to lose. As with any trading strategy, it's important to practice and perfect your skills before diving in. Happy trading.